Yeah, I think we'll get started. So first of all, I wanted to thank everybody who has signed on. Today's webcast will be a conversation or market outlook with Ed Yardeni, prominent Wall Street strategist. My partner, Patrick Somerville, who is senior partner and co-president of the firm, unfortunately at our office in downtown Toronto is experiencing a power outage. So I'm going to be the one who leads you through the early parts of the presentation. My name is Rob Wessel. I'm executive chairman and co-founder of the firm. And I wanted to welcome, excuse me, Ed Yardeni. So first of all, if you go to our website, there's all the necessary disclaimers. Hamilton ETFs at a glance. So we are one of the fastest ETF managers, fastest growing ETF managers in Canada. In fact, I think we are, but we'll just say one of here. Our AUM is safely over 7 billion, and we are across 26 ETFs. We launched 5 this month. We are leaders in Canadian bank in financials ETFs. We're Canada's #1 provider of enhanced ETFs, those that have modest 25% leverage. And we're one of Canada's largest and fastest growing covered call ETF providers. So we have financials ETFs, which are designed and managed by sector specialists. We have enhanced ETFs. All of them have modest 25% leverage. We do have a suite of yield maximizer ETFs. They're income first, which is important to point out. And then we're very, very excited to launch the Hamilton Champions, which are low-cost dividend ETFs, which I'm going to talk about only that today. So essentially, these are dividend aristocrat or dividend all-star ETFs, blue chip companies with a very long history of increasing and/or sustaining dividends. The suite that started is essentially divided into 2 buckets. The first is our MVP suite. So that's on the left, the bottom left of this slide. You can see here, 0% management fee through January 31st, 2026. We have CMVP, which is the Hamilton Champions Canadian Dividend Index ETF. And then we have SMVP, which is the Hamilton Champions US Dividend Index ETF. And then on the right side, we have versions of them that are enhanced with modest 25% leverage. So CWIN is the Hamilton Champions Enhanced Canadian Dividend ETF, and SWIN is the Hamilton Champions Enhanced US Dividend ETF. And maybe the way to think about which one's an MVP and which one is the wins or the winners. You need an MVP in order to win. So the wins are the top funds with modest leverage, and the MVPs are the bottom funds. The MVPs have 0 management fee through January 31st, 2026, as I mentioned. Both of them are based on a selective index. So this is CMVP Canada and CWIN, which is the enhanced. So if you look at the gold bar at the top, that's the return since the beginning of the index for the enhanced version of 11.2%. The index unlevered without the modest 25% leverage is 9.2%, and the underlying S&P TSX 60 is up 7.4%. So you can see that both the unlevered as well as the modestly levered have outperformance relative to the selective index. On the US side, SMVP and SWIN. If you look here, the selective US Dividend Elite Index, I'm echoing Louis, just so you know. Selective US Dividend Elite Index Champions is up here at the enhanced version is up 12.6%. The index, the selective index and the S&P 500 both have very, very similar returns. I'm going to talk about how our US versions have superior risk metrics, but I would also note that the selective index that we're basing this off has a long history of outperformance. There's only recently, with the massive improvement in the Magnificent Seven, I believe, that's kind of closed that gap. But these are much more diversified products. In terms of the very strong performance and lower volatility, we have this table here, so you can see the Canada Elite Champions Index as 9.2 versus 7.4. Its yield is modestly higher. Its risk profile, as measured by standard deviation, is also lower than the TSX 60. Maximum drawdown is lower, and time to recovery is much shorter. These metrics are a little bit more dramatic on the US side, although the returns are relatively similar. The yield is quite a bit higher on the selective index. Standard deviation is meaningfully lower. Also, the maximum drawdown is lower, and the time to recovery is quite a bit shorter, half actually, or nearly half. If you want to learn more about these products, please go to our website, hamiltonetfs.com. We also have a Hamilton Champions dividend growth playbook note, which would give you all the necessary information that you need to learn more about these. And I do want to mention Ed. I think this is like our seventh webcast with Ed. I think almost everybody who is involved with our firm or follows our firm or attends our webcast knows who he is. But obviously, Ed is a heavyweight. He is very, very powerful, or sorry, very, very influential market strategist. Excuse me. He's held positions at the Federal Reserve Board of Governors, U.S. Treasury Department, and he's served as a chief investment strategist at a number of prominent Wall Street firms. He's on CNBC a lot. In fact, we're going to have to end this webcast at 3 o'clock sharp because Ed is going on CNBC today at 3:30. So with that, welcome, Ed.
Thank you, Rob.
Just to talk about, we talked a little bit about before the structure. So for those who are listening in, generally speaking, these webcasts, which we've done in the past, have followed, a relatively consistent format. We like to get Ed's view on the market. We like to get his view on monetary policy and fiscal policy, and then talk about some of the macro risks, and then give Ed some time to conclude. But today I think it's going to be a little bit more free flowing. But one of the things I like to do when we start these webcasts is talk about what's happened since we last spoke to Ed, and put that in the context of what Ed has predicted or has outlined in his previous webcast. So in the last webcast we had with Ed was in late September. It's about 5 months ago. So just for your background, Ed, since then, the following things have happened. It's actually been a fairly eventful 5 months or so. First, the 10-year has risen 75 basis points. So you're now at 4.5. The Fed has cut rates twice. The 2 and 10 yield curve has steepened. The S&P 500 has continued to go up. Went up over 5%. It's obviously had a very, very strong run. In this instance, the PE is flat, so virtually all of that was earnings growth. The unemployment rate stable, inflation stable, and so I wanted to chat with you first. We have in the past consistently followed or talked about your 3 scenarios. So just for the benefit of people on the line, Ed typically lays out 3 scenarios and lays out probabilities. So the first scenario is the roaring 20s, i.e. labor shortages forcing companies to invest in technology, which allows for growth in real GDP. But if there's productivity, it's absent inflation. That's very good for the stock market. Scenario number 2, which Ed has highlighted as one of the possibilities, is kind of a 1990s melt up, where the Fed gets worried about inflation falling and begins to cut rates, causing a melt up in the stock market, typically led by technology. And those are the 2 bullish scenarios. The bearish scenario is a repeat of the 1970s, God forbid. Geopolitical shocks cause oil to rise, pushing up inflation or some other external factor, and the Fed must respond, causing inflation. So I just wanted to ask you, Ed, so since we last spoke, you've increased your probability to the roaring 20s to 55%. You've lowered, that's at the expense of the 1990s melt up, which you now have and assigned a 25% probability, and you've maintained that there's a 1 in 5 chance of a 70s repeat. Did you want to talk about what's caused your changes? And I know this might be at the margins. I would say it's because you've been extremely right, so you've had to make big changes, but I don't know if you want to talk a little bit more about that. I think you're on mute, Ed.
Is that better?
It is, yes. Perfect.
Okay, good. Sorry about that. Well, thanks for the introduction. Yeah, the 3 basic scenarios remain the same with some tweaks. We feel more confident about the roaring 2020s. Part of that because we're basically about halfway through the decade and things have worked out quite nicely. We argued that there would not be a recession. As you know, over the past 3 years, we've had the most widely anticipated recession of all times. It didn't happen. And we were among the few that thought that we would not fall into
Hmm.
recession. We also thought that inflation would come down, and we thought that there be that we're in the digital revolution, and in the digital revolution, we'd see more technology that allows companies to increase productivity, and that's certainly been happening. We've been talking about this since 2019, so we didn't really know that AI was going to come on strong starting in late 2022 when OpenAI uh, introduced ChatGPT. But lo and behold, here it is. But it's not the only technology that increases productivity. It's actually the combination of all the technologies, the automation, the robotics, the nanotechnologies, all the available technologies out there can come together and increase productivity. And that would give us better than expected real GDP, lower than expected inflation, higher than expected earnings. And obviously, this would be fine for the bond market, and it would be very good for the stock market. We're at 55% on that. The other bullish scenario, but a little bit more volatile, would be the 1990s scenario, where the Fed has this perception, as they seem to have, that the Fed funds rate is too restrictive. They have to lower interest rates some more. Our view is the economy is doing just fine with the current level of interest rates. The unemployment rate is around 4%. The inflation rates come down. There's really no need to lower interest rates, but if they do so, that would increase the chances of a melt up. And we're sort of on the edge of that, anyways, right? With multiples at historical highs or comparable to where they were before the tech wreck in the late 1990s. We wouldn't want to see the stock market going up on valuation multiples. We think it's
Hmm.
going to go up on earnings, but if it goes up in valuation multiples, there could be a melt up, but it doesn't have to be a repeat of 1999, 2000. It could be a meltdown that's a quick one and it creates an opportunity to buy. And then the risk bucket is 20%, and that includes it did give a lot of concerns. It had a lot of concerns about geopolitics, oil prices going up, a 1970s kind of style scenario. But along the way, we actually feel a little bit less concerned about that since there seems to be enough oil to keep oil prices down. China's economy is weak, so that's keeping oil prices down. So now there's other things to worry about. We need to worry about a potential debt crisis. It doesn't feel like that today because the
Hmm.
bond yield has come down because Scott Bessent in the Treasury basically is following the lead of Janet Yellen, the previous
Hmm.
Treasury Secretary, and saying that they're going to issue more bills and fewer bonds. So that got the bond market, the bond yield coming down. But we still have to be concerned about a potential debt crisis. So we put that in that bucket. And
Hmm.
then, of course, protectionism. If we talk about the roaring 2020s, obviously we're alluding to the 1920s, and people remind us that, well, that ended badly with the
Hmm.
Smoot-Hawley tariff. And we don't think that's where it's going, but we're going to find out here pretty quickly because obviously tariffs are making the headlines. So that's the way we look at things. And base cases, bond yields are kind of where they should be, 4.5% plus minus 25 basis points. The Fed shouldn't lower rates, but if they do, that increases a melt-up scenario in the stock market. We have it at 7,000 by year end, 8,000 by the end of next year, and then 10,000 by the end of the decade by 2029.
So that's actually a perfect segue. The since we spoke, the by far the biggest event was the U.S. presidential elections, the election of Donald
Yeah.
Trump, the Republicans taking control of the Senate and a much narrower lead in the House. And I guess, we're in Canada here, so the tariffs are taking center stage. You had a daily comment not that long ago where you kind of went through what you thought the impact was per country. So, without getting too much deep into the weeds about
Mhm.
politics, I don't know if you wanted to give your view on the what you think might be happening or what the administration's objectives are as it relates to Mexico, Canada, and China. Maybe we'll start with Mexico. Can you hear me okay, Ed? I think we may have lost Ed, and he is hopefully going to log back on. We'll just reach out to Ed quickly. So maybe what I'll do is I'll summarize a little bit until we can get Ed back on. Some of the things that Ed talked about in this most recent note, the objectives that he laid out, what he speculated or surmised, the objective for the tariffs for Mexico, as he laid out, was to deal with or reduce drug trafficking, including fentanyl. Um, Expected the administration to focus on trying to get Mexico to control legal immigration, and to stymie the perception that China is using Mexico and exports into Mexico and back into the United States as a way to circumvent certain trade restrictions. With Canada, it's a little less clear. But it seemed like, according to Ed, trying to get, again, many of the same objectives for Mexico, although not quite to the same quantum. Also, possibly given that Canada is a major producer of oil, trying to get an energy union, if you will, or trying to integrate more both Canada and Mexico and the United States as it relates to energy production and the energy market as it relates to the three countries. In terms of China, one of the things that Ed had laid out was their objective is he surmised that the objective of the current U.S. administration would be to counter and destabilize China's influence. A perfect example would be Panama and trying to deal with and possibly retake control of the Panama Canal. I don't think Ed wrote that, but that's certainly some of the things that people have been talking about. In terms of what might happen to inflation, one of the things that Ed had talked about, and hopefully we'll get him back on soon, was that the risk of inflation would be there, and that would be an issue, but that the tariffs would represent something more like a one-time increase in the inflation rate. And the thing that he referenced or had the biggest reference point was for 2018, when the tariffs went up in 2018, it didn't have a significant impact on the inflation rate, and therefore he thought that maybe it would be the same thing here. Our view, or I guess my view, would be that it's not really in the administrative interest to get into a trade war and have it negatively impact both GDP and the stock market, and therefore many of these battles will be somewhat transient. But really, it's kind of a threat to try to induce behavior and try to accomplish certain goals for the administration. I was going to ask Ed if we can get him back on. What he thinks the Fed should do, because the Fed's going to be in a bit of a bind. If inflation does go up, there's already the U.S. economy continuing to do well. Inflationary pressures are not accelerating, but they're not decelerating either. So to the extent that there's concerns about inflation going up, the Fed might be tempted to raise interest rates as a preemptive step so that they don't allow inflation to continue to rise. Because, of course, if that happened, then the bond market would have to react, the stock market would go down, and I don't think that that's in the interest of the administration. And given how these tariffs, can come and go basically by executive order, seems like the president is in control of being able to react to whether the market goes up or down, whether it's the bond market or the stock market. So, and then talking about the S&P 500, one of the things that Ed had talked about, and hopefully we'll get him back up, is so for the last time we spoke to Ed was in September. So there was a rally leading into the September webcast. The markets, as we all know, have been extremely strong. But one thing that had happened going into the previous webcast was that there was fairly significant multiple expansion. Since then, the increase in the stock markets in September hasn't obviously been as strong as it was leading into the prior webcast, but it is almost exclusively driven by rising earnings. The S&P 500's multiple has not moved since our last webcast 5 or 6 months ago. Nope, I think we're getting Ed back.
I'm back.
You're back? Excellent. I was doing my best to describe your notes.
Yeah.
So I did talk about because we don't want to go over our time. It's 2:22. So thank you. Sorry for the
Yeah, sorry
so
about that. I didn't
no,
know what
that's
happened.
okay. I mentioned that the objectives, the administrative objectives that you laid out for Mexico, for the U.S. administration was primarily dealing with illegal flow of drugs and illegal migration, but
Yeah,
also to stymie the perception of China using Mexico. Um, and I talked a bit about China, but maybe because I'm a bit too close to it up here in Toronto,
yeah.
is maybe you might want to talk about what you think the administration's thinking as it relates to Canada.
Well, I think the administration has obviously an America First agenda. That's very clear. They're not globalists. They don't look forward, cementing alliances. They view the United States as the world's biggest customer, which gives the U.S. a tremendous amount of economic power over other countries. And I think the administration is using trade as a negotiating tool about all the issues you mentioned, like national security, like border security. And it was interesting that on Monday, the market took a dive on the tariff talk. But then as the day progressed, there was progress made on the Mexican side. And by the end of the day, there was progress made on the Canadian side. It had nothing to do with trade. It had everything to do with national security. I think that Trump throws a lot of spaghetti on the wall and sees what sticks. I think at the end of the day, there isn't going to be a trade war between the United States and Canada, and between Mexico and Canada. We've seen this play out before, right? And during Trump
Mhm.
1.1, he basically renegotiated NAFTA, and it was renegotiated, and the deal was done. But it was basically a negotiation about trade. Now there's bigger issues involved in terms of the way they look at things, and they view just about everything as national security. And of course, the administration sees Canada actually as a very valuable partner. I think Trump likes to take extreme positions because that's the art of the deal. Uh,
Mhm.
Sen Jose threw out the 51st state thing, which really got everybody mad up there, and
Mhm.
I understand. I can understand why. But at the end of the day, it's the end of the day. Let's see what happens by the end of the day. So the morning starts with some sort of statement from overnight on X or social truth, whatever media he's on, gets everybody riled up. I mean, for example, right now, he really threw a major, statement out there when Bibi Netanyahu visited and said that the United States kind of wants all the Palestinians out and wants to develop Gaza as a
Mhm.
Miami Beach. I mean, it's like,
Yeah.
what? I mean, that
Yeah.
sounds totally absurd.
Yeah.
But basically, it's a negotiating position. And I think what he's
Mhm.
basically telling the Palestinians, if you want to stay in Gaza, get rid of Hamas, and then we'll talk.
Yeah.
A lot of this is actually pretty well calibrated. It's calibrated to make a really huge noise and get everybody mad and angry and so on. And then you get on the phone with him and you have a reasonable conversation and you give him something and he gives you something back. So I'm not particularly concerned that this is all going to lead to Smoot Hawley. I mean, we'll stick. We have the tariff issue in that third bucket, and so we'll see how that plays out.
Yeah, so and I tried to describe so you had written that in terms of tariffs should they even be implemented and continued, which has not been the case, that it would be a one-time increase in inflation. So if you thought tariffs were coming in, let's use China as an example where
Yeah.
China would push back. What do you think the Fed should do?
The Fed should do nothing. I mean, that was our point in August of last year when we looked at the economy and we didn't think the economy was all that weak. We thought maybe there was
Mhm.
a soft patch where we thought that the consumer would keep spending and capital spending would be strong. And we couldn't understand why the Fed would do 50 basis points in September when they didn't know any more than we did about who the next president was going to be, what fiscal policy was going to be.
Sure.
It's one thing for the Fed to have the position that they don't get into politics, but they can't ignore fiscal policy. And so they have to have some opinion on that. And it was pretty clear that neither candidate, Harris or Trump, had any intention of making the deficit a political issue. No, that's just a no-winner. So the bond market got worried about that. So the Fed lowered by 100 basis points September, October, November, December of last year, and the bond yield went the other way and went up 100 basis points. I
Right.
think the bond market's basically telling the Fed, no mas. You may have done a little bit too much, but we don't need you to do any more. And with regards to tariffs, what's different about Trump 2.0 and 1.0 is in 1.0 tariffs really was all about economics and about leveling the economic playing field and onshoring and all that. This time around, it's about that, but it's also about national security. And it's also clearly about having a situation where the tariffs might actually raise some revenues. I think the revenues is going to be a frustrating issue because I don't, to really raise, if you had a tariff of 10%, you might raise at most $400 billion a year, which is a good chunk of money. But you can't assume that there won't be unintended consequences.
Of course.
And so it may be very difficult to. I think Trump's got this notion that he could raise a lot of revenues with tariffs, and I just don't think that's realistic.
It just seems like, Mexico and Canada and even Colombia, for example, have, significant interest in conceding to whatever the president really wants, whether they want to admit that or not. But China is definitely one where they, are also, are seeking global hegemony and see themselves as a superpower and are less inclined to give in. Do you think there's a possibility that this even escalates? I know that the first time around, this is all very tiresome. The tariffs are on, the tariffs are off, markets down, markets up, and nothing really happens because the administration, it's in their interest to have a rising stock market, and it's in their interest to have economic growth, and tariffs are counterproductive. And I think they even know that. But what about China, speaking of the unintended consequences of things just continuing to escalate because the Americans are in a stronger position, but the Chinese just dig in?
Well, I think the most important thing we do know is that China's economy is weak. They have probably the biggest property bubble bursting of all times. And our experience from what happened in Japan and what happened in the United States, and I think Canada as well, is that when you have a property bubble, it takes 7 to 10 years to kind of get over the deflationary consequences of that. And so the Chinese have resorted to the same old economic model of manufacturing more for export, dumping goods in global markets, and that's actually been somewhat deflationary. And they've had to stimulate their economy to achieve their growth target, but clearly the consumer isn't really responding, and all in all, it's a weak economy. So the last thing they really need is a trade war. They'll retaliate. There'll be sort of a tit for tat, but it'll be very targeted, and it'll be mostly aimed at influencing American politicians by hurting certain exports from the U.S. to China in different localities where that could make a difference to the constituency of a representative either in the House or the Senate. But all in all, I think even Biden didn't to get rid of Trump 1.0 tariffs on China. So there seems to be definitely an agreement that when it comes to our relationship with China, it's somewhere between competitive and adversarial. And I think the move, I hadn't a clue that there was an issue with Panama. And I thought it was silly when he brought it up. But then, he's got more resources than I do, certainly. And it turned out to be a legitimate concern that the Belt and Road project has created two Chinese ports on either side of the Panama Canal, and that's a vital security interest to the U.S.
Sure.
So Marco Rubio went down there and kind of negotiated a deal that we can live with.
So you've been very constructive. I mean, the S&P 500 has done amazing in the last couple of years, last 2 years. So there was a rally leading into the last webcast we had in September. The markets continued to move, although the leadership or the reason for the move has shifted from multiple expansion to earnings growth. I think, if I'm not mistaken, you're now looking for the S&P to make $310, which I think is up 11% from the
Right.
last time we spoke. And you have the S&P rising 15% in 2025, if I'm not mistaken. Did you want to, and correct me if I think that's right. Do you want to lay out a little bit about, why even though the market has had a very strong
Yeah.
run, why you think it has further to go? And
Uh,
then maybe at the end of that, we can talk about AI and the
yeah.
market's perception about its impact on the market.
Yeah. Well, again, I wouldn't want to see it go higher on valuation multiples because then
Hmm.
that would probably force us to increase the subjective probability of the 1990s melt-up scenario.
Hmm.
But we do think that in our rolling 2020 scenario, that productivity will grow faster than expected. Right now, productivity is at a good rebound. It was down
Hmm.
on a 5-year trailing basis to 0.5% at an annual rate in 2015, and now it's up to 2%. But 2% is the historical average, so it's a lot better than 0.5, but it's just average. And if you got the productivity growing at 2%, labor force growing at 1%, the arithmetic is easy. Just add the two together, and you get 3% growth in real GDP. We think
Hmm.
that productivity growth could go up to 3, maybe even 4% over the second half of the decade because of the technological innovations that apply to so many businesses that so many businesses can use to increase productivity. And if you can do that, why wouldn't you? And if you can do that when you've got a shortage of skilled labor and you need to augment the productivity of workers, why wouldn't you? So we think that's going to be the surprise. And it's not as though that hasn't happened in the past. You know,
Hmm.
in the 50s, we had a productivity boom with productivity growing that fast. In the 60s, we had that. In the 90s, we had that. And I think this productivity growth boom has the potential to be more sustainable and to last longer. It could be the roaring 2020s followed by the roaring 2030s. As a matter of fact, again, we're not looking for a depression, a Smoot-Hawley tariff
Hmm.
kind of event. So all that leads us to conclude that earnings could be better than expected. And I think we have the highest earnings for the S&P 500 on the street at $285 a share for this year, and then $320 a share for 2026, and
Oh,
then
okay.
$400 a share by 2029. And you put a current multiple on it, so we're not taking the multiple down, but we're not taking it up. We think you can get 7,000 on the S&P by year end, 8,000 next year, and 10,000 by 2029.
Now, in terms of the benefits from productivity, and I have a couple follow-ups, but do you think that, so it would seem, and you can correct me if I'm wrong, that the perceptions or the anticipation of productivity improvements from AI has really kind of heavily weighted itself towards five of the what you call the Magnificent Seven,
Yeah.
and that's created more concentration in the S&P 500, and it seems like some of the stock market benefits from this theme seem to be, rather than being broadly spread out across the index, but are maybe more skewed towards a handful of companies. Do you see that changing? Or first of all, do you agree with the premise? And two, do you think that changes?
Well, as you know, about a month or so ago, Goldman Sachs came out with a study that said that because valuation multiples are so high, because the market's so concentrated and these stocks have such high valuation multiples, they're projecting that over the next 10 years, total return in the S&P
Yes.
500 isn't going to be much better than 3%, which is pretty puny.
Hmm.
Now, of course, they're not independent researchers the way I am, because I
Hmm.
don't have any alternative to sell other than our research, and our research says stocks still very, very attractive.
Hmm.
Stocks, of course, to a Wall Street brokerage house that don't give you much in the commission business. But if you can convince people that you can make a lot more money in private equity and debt and other
Sure.
esoteric instruments.
Hmm.
So, I don't want to take anything away from Goldman because more often than not, they agree with us after we forecast, so they copy us a lot.
Hmm. Yeah.
At least that's my recollection. But yeah, I think I think so. These are all legitimate concerns, without a
Mm,
doubt. But I think over the rest of the decade, over the rest of this decade, and they said 10 years, so over the next 10 years, I think the valuation multiple may stay higher. I think the economy demonstrated its resilience. And one of the important variables for valuation is the perception of how strong the economy is to shocks. And if people have, after 3 years of worrying about a recession and it didn't happen, maybe people are starting to realize that this economy can very well continue to grow. And the longer it can continue to grow, the more that earnings will have a runway to grow. And so high valuations now can be justified by a relatively consistent period of sustainable growth in the economy and in earnings. So that's kind of the logic on the valuation side, and on the earnings side, it's very much based on productivity.
yeah, which I know in the past you've described as kind of the fairy dust for the stock market.
Yeah,
But that all that being said, let's accept for the moment that AI is going to be a great theme. It is going to drive productivity gains. It is going to be, a very positive driver of real GDP in
yeah,
the stock market. So let's to assume that that's the case. I think what we have seen in the past, particularly the last tech bubble, kind of starting in the late 1990s and ending in the early 2000s, you did get a huge tech boom, but the market got really carried away and there ended up being a very significant crash and correction.
yeah.
And that still led to very real and durable productivity gains. But in the meantime, the market went way up and then crashed. Do you think that it doesn't seem like that's the dynamic here because a lot of it seems to be focused on what are already fairly large and established companies, or am I missing
Mhm.
something?
Well, I think, history does repeat itself, but more often than not, it really just rhymes. So there's
Mm,
similarities, but it isn't the exact same tune. It isn't the exact same words.
right.
And I think when you go back, and I've been doing this for 45 years, so I
Mm,
experienced a lot of these ups and downs in the markets and the economy. And back then, there was a tech boom in the late 1990s. Part of that was Y2K, concerns that computers
mm,
were going to glitch out because they weren't programmed to
mm,
recognize a change in the millennium. So a lot of money was spent and justified by chief information officers as like, hey, in order to fix this, we really need to, this is a great opportunity to revamp all of our systems. So there's quite a bit of spending that way that's
mm.
basically stopped once we went into the millennium and nothing terrible happened. But the other thing is, people don't really recall this, but a lot of the excess was actually in telecommunications equipment.
I do. I remember that.
And yeah, and I was talking to, I was at Deutsche Bank at the time, and I talked to the junk bond strategist a lot, and he kept telling me how much was being raised in the junk bond market by telecom companies. And what they did is
Mm,
they did seller financing. In other words, in order to sell their equipment, they provided the financing for it, which is a very dangerous thing to do. It
mm.
can really make your sales look pretty good until it doesn't. And so that's what happened. So a lot of that, a lot of the problem was in a specific sector in the technology area. Obviously, the dot-coms also blew up, and
Mm,
after they bought all the computer equipment and telecom equipment, they blew up, and then all that stuff went into the secondhand market and depressed
mm,
prices. This time around, you've got the Magnificent Seven, uh, hugely cash rich in terms of having cash. They don't have much debt. They can they have a lot of cash flow. They have investment banking departments, so they're always looking for upstarts that they can acquire that might they might be able to leverage up into
mm.
bigger market forces. With regards to AI, I think we've been in the digital revolution since 1950. I think AI is
Right.
just sort of the latest iteration of the digital revolution. There was the ag revolution a few centuries ago, then the industrial, now that it's the digital. And the digital revolution is really very simple. It's all about processing as much data as we possibly can in a shorter period of time, as cheaply as we can. And AI really has brought us to sort of the latest level of productivity and data processing. But now we can process so much data and have it spit out so much information that we still can't fathom it all without now software programmers coming up with large language models
Mhm.
that basically help us to work with the software, with the hardware to come up with answers that increase productivity, efficiency, improve customer relations. Now, if you feed an AI model all the information is available on the internet, it's going to be junk in, junk out, garbage in, garbage out, as they say. And the internet will get polluted by LLM models that, will kind of create their own stories and sources and all that. But if you take just your own data that is clean and there's no, you know exactly what's there, and if you buy some data and it's clean and put them into large language models, they can be very effective in
Mhm.
coming to conclusions based on all that information. And again, so AI is really an evolution within the digital revolution, and I think it looks very promising. And I don't think that seek seems to be as big a deal as was
Right.
initially.
Well, I was
Uh,
about to ask you about that because one thing that is different to this kind of surge in technological innovation is you talked about the administration's very concerned about national security, and now you have a very, very powerful adversary seeking global hegemony, or some would say. And so you may recall reading one of the prominent tech investors had said that the previous administration had mused openly with the industry about nationalizing AI, like they did with nuclear development. And now that is probably, was not likely to happen. But anyways, does the national security dimension to this, do you think it has, and we're just totally speculating, do you think that has any possible impact on this particular theme, and that might be something that kind of pops out of nowhere
yeah.
and cuts it off at the knees?
I think once the genie's out of the bottle, it's pretty hard to get the genie back in.
Mhm.
And the analogy with nuclear weapons is, well, the private sector does nuclear, but it does nuclear
Mhm.
reactors, and it didn't do them
Yeah,
very well. And now we're kind of going back to that kind of technology. Um, we've got Bitcoin out there, which is really uncontrollable by governments, and I guess that's one of the reasons that people are attracted to that cryptocurrency. Uh, but with regards to AI, I don't think it's something that a government can
can support. Yeah,
monopolize. And I don't think it's something the government wants to monopolize because
yeah,
it may very well focus on one technology that just doesn't make any sense, whereas the
right.
marketplace will probably do a much better job.
Mhm. Yeah, well, yeah, there's no question. Okay, so we have 15 minutes to go before you need to prep for your CNBC
Sure.
appearance. So maybe we'll talk for a small amount of time on both monetary policy and fiscal policy.
Sure.
So since we last spoke, the 10-year is now 4.5, up from 3.7. Fed funds rate has come down. The 2-year has kind of eliminated some of the benefit. But the 2 and 10 yield curve has widened further. So now it's 35 basis points. The Fed funds rate to the 10-year, which is an alternate yield curve. I know you don't prefer that one, but it's another one people use. Went from being inverted to flat. Do you think the bond market is saying it, or do you think this is the outcome or the product of improved productivity, improved GDP growth, focus on
Mhm.
pro-growth fiscal policy, and therefore the bond market is adapting because the risk of a recession is down, or do you think there's something else going on in here that we should know about?
Well, I think for a while there, when the Fed lowered the Fed funds rate by 100 basis points from
Mm,
September 18th through December 18th, the bond yield went the other way, 100 basis points. And
yeah.
I think it was reasonable to interpret that as sort of the bond vigilantes uh, basically giving a vote of no confidence to what the Fed was doing and basically telling the Fed that they were going the wrong way.
Mhm.
No reason to raise rates, but there certainly was not necessarily any reason to lower interest rates. But the bond market, as all of us know that have been working with it for a while, bond market's affected by a lot of variables. In the past, it was mostly what the Fed's going to do and what inflation is going to do. But of late, the actual supply and demand issue has become relevant. I think we saw
Mm,
it today, where as I said at the beginning, the new Treasury Secretary is just carrying on the policy of the previous Treasury Secretary and saying
mhm,
we'll continue to issue more bills and we're not going to increase the bonds and the bond market like that. And so I think we're actually below 4.5% last I looked on that news. Um, but obviously, other variables will be important as well. But for now, I think we need to focus on what the Fed's going to do, what inflation's going to do,
mm,
and what the Treasury is going to do. And I kind of believe that the bond yield should be around 4.5% plus minus
mm,
25 basis points. That to me
mm,
is normal. That's where it was before the great financial crisis.
mhm,
I think it reflects a decent return for people who don't want to take risk. I mean, it is still widely viewed as one of the safest assets around, and I think it is. So I really don't see a problem with it staying right at this level.
mhm. So the last time we spoke, we both agreed that it didn't seem like either of the two candidates for president was really serious about talking about deficits and debt.
Yeah.
Um, Now the president has been inaugurated and he's taken office. What do you make of this Department of Government Efficiency or DOGE?
Mhm.
Elon Musk had, the government spends, U.S. government spends about $8 trillion. Elon Musk recently, who's I guess seemingly quite influential, has suggested that 10% of government spending is out and out fraud. There's at least 15% that is waste. They do seem serious about this. So is the glasses half full that some of what might happen is pro-growth fiscal policy gets you incremental GDP growth, and maybe they are successful at weeding out some waste
Yeah.
and slowing the growth of debt to GDP? Is that, or is that is that just too not myopic, but too optimistic?
The new Treasury Secretary, Scott Bessent, when he uh, was obviously promoting himself, said that his goal would be to lower the deficit from 6% of nominal GDP to 3% of nominal
Mm,
GDP. And one of the ways that he wanted to get there was to um, stimulate the economy more. And so he
mm,
said, we think we can do 3% economic growth. And then so this is just 333. The third three was, lower the price of oil
mm,
by $3 a barrel. So these are all kind of related issues. But in my rolling 2020 scenario, it's really quite possible that better than expected growth will help that ratio of deficits to GDP come down. In addition to that, if you have better than expected growth, you're going to have better than expected revenues, right?
mm,
So growth can solve a lot of the problems, but it's still there's a political issue. There's a political problem, and I
mm,
think the Doge committee is demonstrating to the bond market that they are serious about cutting tens of billions of dollars, and maybe if they do enough of that, it'll add up to some significant sums that do have an impact on the debt to GDP ratio. So, yeah, as you said, nobody was really talking about the deficit during the campaigns. It's not a winning
sure.
it's not a winning campaign issue, but I think Trump is in the same position Clinton was in. Clinton was told in the early '90s that he couldn't do everything he wanted to do because the bond market wouldn't let him do that.
Mhm,
Robert Rubin and James Carville told him that,
mhm,
and I think Scott Bessent and maybe some of his other advisors are going to let him know that you really can't do your tax cuts unless we come up with
sure.
with more revenues and some cuts in outlays.
Yeah, I mean, I guess the other side of whether this can have any real impact is whether it's more symbolic and it makes for political wins, but at the end of the
Mhm.
day, if you're going to have tax cuts and interest costs are going to continue to rise, something
Yeah,
that we got very familiar with here in Canada
yeah,
in the early 90s, that there's really, I mean, if you're not going to reform Social Security, Medicare, and you're not going to
yeah,
cut defense, that at the end of the day, you're just on a treadmill, and until you can
yeah,
reform any of those bigger, which
yeah.
doesn't seem so. It just seems like, well, I guess economic growth is going to be the one area that can moderate this issue or at least defer it.
Yeah, I mean, the other thing is the world is getting wealthier and wealthier. and the
Mhm.
wealth likes to be diversified, and there is a demand for bonds. You
Yeah.
know, when the bond yield got to 5% in
Mhm.
2023, and on November 1st, there were a lot of buyers. Of course, Janet Yellen came in and said we'll do more bills on its bonds,
Mhm.
but there is a yield at which there's plenty of buyers, and the question is whether that yield uh, hurts the economy or not. And so far, we haven't gone to that extreme. But you're absolutely right. I mean, even Musk, when he was, offhand said that he could cut $2 trillion off the deficit, and he never said over what period of time. And then when he updated his view, he said, "Well, it's not going to be a 1 year uh,
Mhm.
phenomenon." So he's being more realistic about it. But it's a big country. It's a wealthy country. It's a big world, and there's a lot of wealth in the world, and a lot of it wants to be diversified. And as a safe asset, the Treasury bond still stands right up there. I don't expect that the dollar is going to be upended. I think the dollar is going to remain strong because it's
Mhm.
going to reflect the strength of the U.S. economy, and that's totally consistent with the rolling 2020 scenario.
Right. And so we have about 6 minutes to go. So why don't we talk with the I'll skip to the last question, which is the conclusions. So on equities, you're still in terms of stay home versus global, you're still stay home.
Realizing that Europe has actually done pretty well of late, and I think it's been basically a valuation decision. People have decided that the U.S. economy PE is too high for the S&P 500, maybe certainly for the Magnificent Seven, and
Hmm.
so they're looking for cheaper stocks in Europe. The problem is Europe's economy's got a lot of problems, much more than the U.S.
Yeah.
We all know the issue of
Hmm.
regulation and immigration is the immigration is usually a positive for growth, but not if the immigrants don't mix in well with your culture or don't accept your culture. So there are issues in that regard. U.S. Immigration, even illegal immigration, benefit of hindsight, probably boosted economic activity. I don't think we're going to have
Hmm.
deportation here in the United States, and they're only, some of the more right-wing parties in Europe are starting to talk along those lines. So it's a fluid situation, but I think all in all, Europe doesn't have the capital markets, the venture capital, the distressed asset funds. Um, but it's got good companies and that do business on a global basis. And so I'm not telling you not to invest in Europe, but I am saying overweight the US still.
Yeah. And I mean, net zero has obviously been extremely harmful to European GDP growth as well.
Well, the transition has been a disaster, and
Yeah.
Germany's suddenly realizing that if the wind doesn't
Yeah.
blow, that's an issue. So yeah, it's been a botched job for sure.
Yeah. Well, the global head of net zero is running for prime minister. So here in Canada. So we'll see how that goes. But
Yeah,
in large cap versus mid cap, the mid cap financials actually look very good relative to the large cap. But I don't know if that's more of a financials specific. Do you have
yeah, no,
any
no,
views?
I we agree with that. I mean, we would. Well, we're not seeing any growth in the S&P 500 and the S&P 600, which is the small caps. Earnings just aren't growing. So, that's been a good valuation play. It was cheap, and now they're less
Mhm.
cheap. But we can't get excited about stocks when, analysts are telling us that earnings are in a flat line. Mid cap are seeing more signs of life, and I agree with you. We've liked the financial sector all along. We thought it was one of that we needed to be overweight. We're
Mhm.
still overweighting technology and industrials, so we're staying with those themes.
So, well, we did it. A power outage in Toronto. I
Yeah,
lost some connection with you, but we still
yeah,
managed to get through the full
yeah,
1 hour. So first of all, I wanted to thank you, Ed, for
sure.
everybody on the call. We strongly encourage you to go to quick takes at yardeni.com. Advisors on the phone, we think it makes a ton of sense to subscribe to Ed's newsletter. It's excellent content, and I guess the fact that Ed has been consistently right, if not the most accurate forecaster, is in and of itself a pretty important reason or a pretty good reason to subscribe. So with that, Ed, I wanted to
Thank you,
thank you
Rod.
very much, and we'll be watching you on CNBC at 3:30.
Okay, thanks a lot. All the
Okay.
best, everybody. Bye-bye.